U.S. economy grew faster than expected in Q2. The U.S. economy is experiencing fantastic growth in the second quarter, exceeding expectations. This growth is supported by the resilience of the labor market, which is boosting consumer spending, and businesses are investing in equipment, effectively averting the much-feared recession. The Department of Commerce's Advanced Second Quarter Gross Domestic Product, GDP, report indicates sustained strength in domestic demand, while inflation has significantly subsided during the last quarter. This decline in inflation has led some economists to believe that the Federal Reserve might not need to raise interest rates beyond this year. Instead, borrowing costs could remain higher for a while. Recently, the United States Central Bank raised its policy by 25 basis points to a 5.25% to 5.5% range. Christopher Rupke, chief economist at FWD Bonds in New York, expressed excitement about the economy's resilience. He believes the solid second quarter growth demonstrates the economy's triumph over predictions of an inevitable recession following the shock inflation and the Fed's aggressive stance rates to control it. During the last quarter, GDP increased at an annualized rate of 2.4%, higher than the 2% pace in the January-March quarter. Economists surveyed by Reuters had forecast GDP rising at a 1.8% rate in the April-June period, showing the economy's better-than-expected performance. The government's price index for gross domestic purchases, which measures inflation in the economy, increased at a 1.9% rate, a significant slowdown from the 3.8% pace in the first quarter. Excluding food and energy prices, inflation rose at a 2.6% pace, following a 4.2% rate of increase in the first quarter. Despite facing 5 basis points in rate hikes from the Fed since March 2022, the economy has remained resilient outside the housing market and manufacturing, demonstrating its ability to combat inflation. Economists have been predicting a downturn since late 2022, but with price pressures easing, some now consider the Fed's envisioned soft landing scenario for the economy to be feasible. Consumer spending, a vital driver of over two-thirds of the U.S. economic activity, increased at a 1.6% pace, although this pace was slowed compared to the first quarter's robust 4.2% rate. It still contributed more than a full percentage point to GDP growth. Spending on long-lasting manufactured goods decreased after a boom during the COVID-19 pandemic, but outlays on services have helped pick up the slack. Spending is being supported by accumulated excess savings during the pandemic, estimated by economists to be as much as $2.1 trillion at one point, alongside debt and strong wage gains resulting from a tight labor market. Companies have been holding on to workers after facing difficulties finding labor during the pandemic. Thanks for watching. Make sure you subscribed and smash the like button. We really appreciate your continuous support.